Recording. So, good afternoon, everyone. Welcome to the class where we are discussing the important concepts of derivatives. In derivatives, we have discussed about forward contract, about future contract. We talked about the reason why forward contract came in picture. So, the forward contract was always being used from the time when we look into the evolution of derivative instruments, the time when the individuals or maybe corporate or maybe traders they were looking into derivative as a risk minimization or as an hedging instrument. So when we look into forward contract contains the problem of default risk. So in order to make sure that default risk issues to be minimized, the future contract came in picture, where future contract is the form of forward contract which need to be traded over the exchange. Okay, but future contract is not customized. It is created by the exchange, and both the parties has to follow the terms which is quoted by the exchange. That's why the instruments or the underlying asset like currencies does not get much popular in future contract. If we look into the volume of transaction of currencies in the future market is comparatively very less. And altogether, guys, if you see the banks or any other financial houses, for them, currency is like an inventory. So they need to keep on transacting between different currencies at every moment of time, either to work on hedging or arbitration or speculation purpose. So for that reason, although for normal individuals or for corporates, future or options contract on currencies does make some sense, but for individuals, uh, but for individuals, currencies trading does not make much sense. Okay, so that too on forward contract. So normally traders, when they do transaction on currencies, they do transaction on something called outright quotes. So you see outright quotes, you see exchange rate. Whenever you look into that, you see exchange rate, something written like this. You'll see exchange rate. If I show you something, some example of exchange rate, so it is written maybe the the dollar rupee value, euro dollar rupee value. Maybe this is spot rate. Spot rate means at what rate you can transact right now in the currency. Maybe it is given like this: 0.02479/81. This is spot rate. Then you have 1 month contract, you have 1 month forward contract, 1 month forward contract, and the quotation is given like this: 3 by 5. And then it can be 3 month contract, it can be 3 month forward rate contract. It is given as 8 by 7. It is given as 8, right? 8 by 7. Or it can be 6 month contract, it can be 6 month forward rate agreement, where the exchange rate is given as 13 by 10. So this is a very common representation what the trader normally used to follow whenever they talk about transaction of foreign currencies. Very usual representation. So normally when we see this representation, this is maybe this they are talking about the transaction of dollar with in the term of rupee. Maybe they're talking about rupee in the term of dollar. 1 minute. Yeah, so, yeah. 1 rupee is equal to how much dollar? They are talking about in that frame of reference. So 1 rupee is equal to how much dollar? So you know that rupee is weaker currency than dollar. So definitely you'll get in decimal. So some values are given to you like this. So that is a usual representation what the trader normally use whenever they talk about transaction in the market. So when you see this form of transaction in the market, you need to understand here the two values are given. So here you can see that here 1 rupee is equal to 0.02479. This is called bid quote, and then 0.02481. This is called ask quote. So guys, if you see at currencies, when you see the value of the currency here in the spot market, you can see two values being written for you. This is called bid quote. This is called bid quote. This is called bid quote, and this is called as the ask quote. When you say bid quote is the rate at which bank buys foreign currency, and ask quote is the rate at which bank sells foreign currency. So you can see here 1 rupee is equal to this much dollar as a bid quote, and you can see this. Okay, so 0.02479 is your bid quote, 0.02481 is your ask quote. This value is given to you. Always remember that your ask quote is always more than bid quote. Bid quote is the quote at which the bank buys foreign currency. Ask quote is the quote at which bank sells foreign currency. The difference between bid and ask is called spread percentage. Spread percentage formula is ask quote minus bid quote. The spread percentage formula is bid quote minus ask quote. Sorry, minus bid quote divided by ask quote into 100. So the spread percentage basically talks about the liquidity of the currency. How much liquid is the currency? So the liquidity of the currency is basically talked about by spread percentage. More liquid is the currency, lesser will be the spread percentage. Less liquid is the currency, more would be the spread percentage. So the because of inappropriate liquidity, bank end up in buying a currency at very lesser value, and they'll sell the same currency at very high value, and thereby they make huge profit. So imagine what do you mean by this? Imagine that tomorrow if you go to the bank with 1,000 rupees, you go to the bank with the 1,000 rupees, say that you want to go to US, say that you want to go to US. So you have 1,000 rupees with you. You say that I'm going to US. So because I'm going to US, I need dollar. You say because I'm going to US, I need dollar. So do one thing. Look, take see at what is the present exchange rate. On that present exchange rate, give me dollar. So give me dollar. So what the bank will do? So bit you know that what is Bitcoin? Bitcoin is the rate at which bank Bitcoin is the rate at which the bank buys foreign currency. Ask quote is the rate at which bank sells foreign currency. So if you have 1,000 rupee with you, what bank can do? Bank will buy rupee from you at 0.0279 per dollar, okay, and bank will sell rupee to you at 0.02481 dollar. So you see this and you tell me so how much value the bank will give you in dollar. So you understand if bank will take $1 is equal to zero point 0, if bank will take $1 is equal to 0.02479 dollar, 1 rupee as 0.02479 dollar. So 1,000 rupees. So the 1,000 rupees will be how much? Went into 0.02479. So that will be equal to $24.79. So bank will give you $24.79. In this case, the bank will give you $24.81. What the bank will try to give you, less or more? Every individual will try to give you less, right? Then only they make the money, right? So bank will buy the rupee what you want. If you go to the bank, so the bank will buy rupee from you at 0.02479. And tomorrow, when you roam from the US, you got $24.79. When you came back to India, suppose now you have $15 with you, and you'll say to the bank in India that give me now rupee because in India I cannot use dollar. So at what rate the bank will give you? So at what rate the bank will give you? So if bank will give you at 0.2479, so then the bank have to give you how much rupees? The bank has to give you 15 divided by 0.02479 rupee. Or if bank have will give you rupee at 0.02481 dollar, then bank will have to how many rupee? That will be equal to 15 divided by 0.02481. So definitely here the bank will have to give less money. You're getting me right? So bank will give you at what rate? Bank will definitely will give you at this rate. I hope you're understanding. So every time you use your common sense, figure it out as looking at the perspective of bank and at what value the bank has to give you at the list. So that will ultimately will help you to decide the exchange rate. So whenever you go to the bank, you always see the quotation like this. Normally, the forward contract is allowed only between different individuals, different banking institutions, okay, which they do use among themselves to buy or sell currencies among themselves. Normally, individuals are not as such allowed to participate more into currencies trading. If they want for hedging purpose, if any companies need, because there are a lot of export oriented and import oriented companies are there which may face problem based upon rupee dollar movement. So they many times go to the bank to help them into their situation, probably when they're expecting or receiving money. Imagine if I'm export oriented company, for me it would be very important that the dollar should always appreciate and rupee should always depreciate. Or if I'm import oriented company, I will be very happy if rupee will appreciate, dollar will depreciate. So depending upon the concern what I have, I may go to the bank for asking for the help. So that is very usual phenomena. So normally individuals or corporates are not allowed as transact in the forward contract. They can only transact in the future contract. Okay, so when we look into the, so banks among themselves can do transaction, can talk about transaction among themselves, and this way, when we try to determine the rate, we call this as this way. If we try to determine the rate, we called as the determination of outright quote. We'll call this as a determination of outright quote, which is very common in the forward contract. In the forward contract in the currency market, it is very common. Now normally, to avoid time and to use this as a language among the traders, those traders who use currency for the speculation or for investment reason, the banks who use currency for the hedging purpose, they use this quote. When you see these quotes, you can see there's a P divide by Q. You can see this 3 by 5, 8 by 7, 13 by 20. Here remember that if your P is less than Q, then understand your forward rate is at premium. Understand your forward rate is at premium. While if while if your P is greater than Q, while if your P greater than Q, you need to understand that your forward rate is a discount. You need to understand your forward rate is at discount. You need to understand this part. Your forward rate is a discount. Okay, so these things we can understand this, guys. So if this is 3 by 5, if 3 by 5 is less than 1, then your forward rate is at premium. While if 8 by 7, while if you see 8 by 7, 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 more than 1, you know that, right? This will be at premium. 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 This will be at discount. This will be a discount. This will be at discount. So if your P by Q is more than 1, then it will be a discount. If P by Q is less than 1, then it would be a premium. Okay, so understand this part. Okay, now premium is what? Forward rate is at premium. Forward rate is at premium. If forward rate is at premium, what this mean? If forward rate is at premium, what this mean? If forward rate is at premium, what this mean? It means your forward rate is more than spot rate. If forward rate is at premium, what does mean? It means that your forward rate is more than the spot rate. Okay, if your forward rate is a discount, what this mean? It means your spot rate is more than forward rate. The forward rate is at premium. So if you want to find forward rate premium percentage, if you want to find forward rate premium percentage, it is end day forward rate minus spot rate divided by spot rate into 12 by M into 100. So by this way you can find the forward rate premium percentage. Similarly, forward rate discount percentage, if you want to find, So that will be forward rate, that will be spot rate, because spot rate will be more. Spot rate minus forward rate divided by spot rate into 12 by M into 100. Where M basically talks about how many month contract. Many time in books and all you see 360 by N, where N talks about number of days of contract. So this part you can understand, guys. This part you can understand. So this part try to understand by yourself. So here, when we look into the exchange rate here, when we look into the exchange rate, so here the spot rate I write 0.02479. This is 0.02481. Okay, then dollar per rupee. This is your spot rate. Okay, you know what is bid rate, what is ask rate. Any doubt, anyone? Whatever I have done so far. Anyone have any question? Any question, guys? Whatever I've done so far. Are you getting this, guys? Anyone have any question? Please respond, everyone. Please reply. Anyone want to ask anything? Are you people understanding what I'm doing? So, so in your exam, 100% one numerical come from this. If you want a spread percentage, guys, spread percentage, you can easily find your spread percentage. Your spread percentage here it would be 0.02481 minus 0.02479 divided by 0.02481 into 100. This will give you spread percentage. So 3 by 5 forward rate is 3 by 5. This is a premium. This will be at premium. This is at premium. So this is at premium. So if this is at premium, so you can write the exchange rate. Premium is added. So the exchange rate will become 0.02479 plus 3. So 79 plus 3 means 82, right? 79 plus 3 means what? 82, right? 79 plus 3 means 82. So write the exchange rate as 0.02482. Then here you can see the ask rate 0.02481, 0.02481 plus 5, do 5 plus 5. So your exchange rate will become here 0.02481 plus 5. It will become 86. So this is your dollar. This is your dollar per rupee. It become dollar 0.02482, then 0.024 81 plus 5, 86 per rupee. Here everyone, 3-month exchange rate. This is your 3-month exchange. Anyone, any doubt? Sorry, 1-month exchange rate. Are you getting this, guys? Anyone, any doubt? This will be your 1-month forward rate. You understood this, guys? So this will be your 1-month forward rate. So if you ask me 3-month forward rate, 3-month forward rate, so 8 by 7 means this will be a discount. 8 by 7 means this will be a discount. So how will you find the value 3-month forward rate? This is 79 minus 8. So what will be your exchange rate? So 79 minus 8. So 0.024. 79 minus 8 means 71. This would be your bit rate slash this 81 minus 7. 81 minus 7 means what, guys? 81 minus 7. 81 minus 7. How much you'll get? 74, is it? 74 plus 7. So 0.02474. So this will be dollar per rupee. Anyone, any doubt? Discount means minus. Premium means add. 13 by 10, again, this will be a discount. If this will be a discount, then what will be exchange rate? 0.024. 79 minus 13. 79 minus 13 means 66. So this will be 0.024. 79 minus 13 means 66. And then you have 81 minus 10, 71. 0.024. 0.02471 per rupee. Clear, everyone? Ask me if anyone have any doubt. So whenever this P by Q, when you see them outright quote in P by Q, if P is less than Q, then your forward rate is at premium. And when is at premium, add that outright quote to the spot rate. While if your P is greater than Q, then your premium rate, then your forward rate is the discount. If your forward rate is a discount, then subtract the outright quote from the spot rate. Anyone, any doubt? Suppose if I ask you determine 3-month forward rate, determine 3-month forward rate, ask quote, determine 3-month forward rate, ask quote, premium or discount percentage. Suppose if I ask you determine 3-month forward rate, ask quote, premium or discount percentage. So you can see, guys, you can see this, your spot rate is, you can see your spot rate is dollar 0.02479, 0.02481 per rupee, and then your 3-month quote, 3-month forward rate is 1 month, 3-month, that is 0.02471, 0.02474 rupee per dollar. So you see this value. If I want 3-month forward rate, ask quote premium or discount percentage. So ask quote means you have to see this value. You have to compare with the spot rate. You have to see this ask. You can see that forward rate is less than the spot rate, right? So because your forward rate is less than the spot rate, definitely the forward rate is a discount. Definitely the forward rate is discount. So means forward rate discount percentage, then it would be spot rate minus forward rate divide by spot rate into 12 by m. M means 3 months. M means how many month contract into 100. Can you do this? Solve this. That is your answer. Anyone, any doubt?